In Dr. Alexander Elder's excellent book, Trading for a Living, he writes about his two main pillars of risk management, the 2% and 6% rule. The 2% rule refers to never risking more than 2% of your account capital per trade. The addition of a stop loss helps guarantee this. In Elder's words, if you trade without a stop or risk more than 2%, you're a swimmer waiting to be attacked by sharks. But that isn't the only way to go broke, of course. To avoid death by 1,000 cuts, Elder's 6% rule comes in, whereby you pause trading for the rest of the month when you hit a monthly maximum drawdown of 6%. This drawdown includes both closed losses and open trade risk, which I will illustrate later. The 6% rule helps protect you when your strategy starts underperforming for whatever reason. Perhaps your strategy was overfit, or market conditions have changed, either temporarily or permanently. No matter how great your strategy is, it will start underperforming at some point. Backtesting is largely unemotional, and drawdowns may seem trivial over the course of a long-term backtest. In live trading, however, you never know for sure. With the 6% rule, you can pause trading during such periods and live to fight another day. Let's see how to apply this rule in practice. First, calculate your maximum allowable loss for the month. With a $10,000 account, this translates to $600. Next, sum up your closed losses and open trade risk. Suppose we have $200 of closed losses and 3 open trades in, say, stocks, for simplicity's sake. The risk per trade is the number of stocks multiplied by the difference between the entry price and stop loss. For the second trade, suppose the trade went well and the stop loss has been shifted to break even. In this case, the risk becomes 0. For the third trade, suppose a trailing stop is in place and a portion of profits has been locked in. The risk is negative in this case. The total risk across the account is therefore $380, giving you $220 of available risk. You can only open another trade if it risks less than this amount. If you spot a fantastic trading opportunity that risks more than $220, you can consider reducing your open trade risk by either closing a trade or shifting the stops in your favor. If trade 1 moves favorably, and you move your stop up to $98, you get another $90 of available risk. This cycle refreshes at the start of every month, when you calculate your new drawdown limit using your current account balance. With a 6% loss limit, you know you won't lose more than 17% over a 3-month period. You don't always have to use 6%, of course. If you have been stopped out for 3 months, you can lower the limit to 3% for the 4th month onwards. Regardless of how you apply the rule, its purpose is to help avoid unfavorable market conditions and give you some time to consider alternatives. You can think clearer after you stop the bleeding. This limit has to be selected in accordance with your risk per trade, of course. With a 3% monthly loss limit, your individual trade risk probably should not exceed 1%. These loss limits can apply at both a strategy level and portfolio level. For example, say you have a 4-strategy portfolio, with each strategy risking 0.5% per trade. If the portfolio as a whole loses 6%, you can pause the entire portfolio. If you're applying this to a single strategy using AlgoWizard, you can program something like this. First, you assign a variable at the start of each month that corresponds to your initial account balance. Then add a condition to your entry tab that checks that your account equity is at least 94% of your initial balance. Account equity is your balance plus any open profits or losses and is different from Elder's concept of available risk discussed earlier, but I think it's close enough for risk management purposes. Like anything in trading, using this drawdown limit has some downsides. Unlike single strategy application, I doubt there's an easy way to backtest this loss limit when applied at a portfolio level. Without a backtest, it's difficult to determine the long-term benefits of having this loss limit. Secondly, if you have paused your trading, you may miss out on profitable trades that bring you out of the red. This is especially relevant for trend followers, since explosive breakouts usually occur after a period of consolidation, where a string of small losses will likely occur. Such loss limits are therefore a judgment call you'll have to take. I prefer to err on the side of caution and use one, since there are few things more important than capital preservation. Hopefully this little tip can help with your risk management. To learn about your risk of ruin, check the video at the top. If you're interested in the Kelly criterion, check the one at the bottom.